fellow traders, 'tis I, the Rumpled One, coming to you on Tuesday, March the 4th. The year is 2025. Let's talk trading. Thoughts on position size with Walmal. These videos are for educational purposes only. Your results may differ from mine and different from Walmal's. And a friendly reminder, always have your risk management in place. Never lose more than you're willing to lose on one single trade. And while I have this screen up, it has the equation position size equals risk divided by stop loss. So Walmal, um, we were talking a little while ago before the video, and I said, you know what, we should be talking about this and make a video. And I made the comment about position size. If it was so small that it didn't matter if it went against you 100 pips or so, you could just trade your way out of the mess.
Yeah, it's funny because we always go and say, or when I say we, I mean the trading community as a whole. We always say, where do you put your stop? That's always the big thing out there. It's funny because you come up with a new way of trading a horizontal line, because that's all you do is trade horizontal lines. But you come up with a new way of going and drawing that horizontal line out there, which I would make the argument, more times than not, it puts the line in the same spot that some of your other indicators would have put it to. It's just a different way of actually putting it out there, and a different way of looking at it. But the inevitable question that always seems to get asked is, okay, so that's how you get in. Where do you put your stop loss? Because people are afraid of losing money. That's a legitimate concern. And, the reality is, you look at it, and sort of like, if I'm looking at a 1 minute chart, well, it may scream that I need to get out at this level. But if I look at a 5 minute chart or a 15-minute chart, it may say that, I need to really look at this level, or an hour chart, or a daily chart, And so, but as you go up in time frame, your distance goes further and further out. And so, those other little places that are there, they may just get blown through or never reached. You don't know. And so the question comes down to, where do I place these? Where do I put it? Where do I put that line? Well, I'm going to go and say something that's going to be, what do I want to say? That's going to be, I'll be called crazy for this. What if I was to tell you that people at big institutions, banks, so on and so forth, may not put stops out there at all? And I stopped there and paused there purposefully.
You're crazy.
Exactly. I'm waiting for everybody to start screaming. You're crazy. Well, I'm telling you right now that's I had a very good friend until he passed away. That he worked for a very large bank, and he did currency trading for the bank. And I asked him, how does the bank go and put stops out there? And he said, what are stops? And why was the bank able to get away with that? Well, they were able to get away with that because they're not trading, a $100 account, or even a 5,000 account, or 10,000, or even 100,000. No, they're trading. They're sitting out there with an account size of several million, maybe tens of millions, maybe even hundreds of millions. And so it becomes inconsequential to them, because what do? They just make sure that what happens is that when they make their trade, their position size, the ratio, let's go call it that, the ratio between the position size and their account size is so large that we can run 100 pips, we can run 200 pips, we can run even 300 pips, and it doesn't matter to them. It just doesn't matter. And so that's something to think about. The fact that we could go and run 100 pips away, and we may not be happy about it, but at the same time, it means nothing from our overall account size. Well, how do you do that? Well, you just got to make sure that the number of lots that you're risking is small enough where it doesn't matter. And then you say, well, I only got, $1,000 account. Well, maybe that means you're trading a dime. I mean, that's, that may be the reality, because when you have that ratio of a dime against, 100 pips, 100 pips times a dime is what? It's $100. $100 is not going to kill your account.
That's $10.
$10, I'm sorry. Yeah, so, it's nothing to your account, and that's just the reality. It's absolutely nothing to your account. But then, of course, the argument about going against that is going to be this. Well, if I'm only trading a dime, I can't make any money. Yeah, you're right. It's going to be very difficult to make some money unless, a couple of things happen. One, the first thing that can happen is that over time you keep on trading dimes, and all of a sudden now you don't have $1,000 account, but over time you build it up. And maybe now you get now trading a $1,100 account, or a $1,500 account, or a $2,000 account. Now all of a sudden that dime can now go to 11 cents, or 12 cents, or 15 cents, or 20 cents. Now you're stacking the money up twice as fast, and you still have that buffer in there that you can run that far against you. Now, why do I say that works in FOREX? And TRO and I were discussing this morning. I said, I wouldn't do this in the stock market. The stock market does this. It tends to run in one particular direction and take breaths, and then go back into that same direction. You look at the Dow, or you look at the S&P since the beginning of time, okay? And if you were to just go and make the chart, small enough, okay, what you can do is, if you go and make that chart small enough, basically you could draw a straight line from the beginning of time to today. And it's a straight line in one direction, and that is up, with setbacks in between.
Hey, so, Walmal, did you notice
yes,
we
sir.
just broke the 2,700?
Yes, I did. Yep. But, we'll get to that in a second. But in any case, it tends to run in one direction. The pound, pound dollar, because that's what I trade, so that's what I'm going to talk. But I can go and say that this is true for most of the Forex pairs, if not all. It's a captured audience. And so what happens is that the pound goes up, and it comes down, it goes back up, and it comes back down, and it's stuck in an infinite range. And so when you look at it, you can go and see that the pound, since the beginning of time, we've been trading this, it's been going from basically a little bit over $1, to I think the high was somewhere around $1.65. So that's 65 cent difference. That's a big difference, But the thing is, it just tends to go, and when it hits extremes, it goes back the other way. And that's just what it does. Well, if I can sit there and be in a trade, and I can let it run 200, 300, 400 pips against me because the position size is so small, you know what? I can get away with, that forbidden thought of never lose.
Oh, the pound was actually over $2 back in the early 2000s.
That's true. I forgot about that. That's true. I forgot about that. I was thinking I was only going back to like 2009, but yeah, you're right. But still, it's within, basically it's a 100% move. That's all it ever was a 100% move. But it came back and, ran up to the $2, ran all the way down. I mean, think about it. Earlier, or in the early part of last year, we were $1.19. We're, we think about that. Now we're at $1.27. But the thing is, it just runs back and forth like that. So we can go and almost count. Of course, you can never count all your chickens, but the thing is, you can almost count on the fact that what it's going to do is it's going to run in a particular direction, it's going to find a place and then run back the other way. So just a thought, keep your position size nice and small so that you can go and let something get away from you. And at the same time, you can then go and continue trading, maybe even trading other, you can continue trading the next day. Sure, I got this one trade where it's gone against me, but I'm making money on today's trades, even though yesterday's trade went south on me. And I'm just sitting there saying, hey, yesterday's trade, eventually it's going to come back, and with that thought, as long as, again, you keep your position size small enough.
Yeah. And on the other hand, you can be reckless. Let's say you have $1,000, right? But rather than put the $1,000 in the account, you put in $100 and you risk half of it. So in other words, you'll risk $50. Basically, you can half your account. So, you can wind up doing that once, twice. Now you're down to $25 in your account. Third time it's $12.50. But then it's like, how bad a trader are you? I mean, because all you'd have to do is hit one hot streak where you win maybe, 5, 10 times in a row. And then you have just really racked that account up. And then when you get it to a certain size, rather than push your luck, you then drop it down to where you're within the conventional risk management strategies. It's one of those crazy thoughts out there.
Yeah, I mean, it's I'm not saying that this is for everybody,
right?
But I just want to go and lay it out on the table because why do the banks always seem to make money? Well, this is one of the reasons why. This is what they're able to do, and that just shows you the power of account size.
Right.
And so my last thought on all this is simply this: your number one goal when you're first starting out, anyway, is not to go and make a salary. Your number one goal is to build your account size, because without the account size, you've taken some tools out of the shed that you can't use. But if you build your account size, you've got more opportunity to do additional things. I mean, sort of like if I have a trade go against me, I talked about this yesterday a little bit. Sometimes it'd be nice to go and say, hey, price ran against me, and I know this thing is going to come around because I can see this, this, and this. It just, but the reality is I need to go and get in at a better price than what I bought at originally. And if I don't have a big enough account size, I can't do it. And so your number one goal has got to be build reserve capital, obviously. And then number two, build that capital.
Right. Oh, you said you were going to tell him about the 2700. He said,
well, you called that out, earlier today because it was just obvious that this thing, it's run 75 pips. We have a imbalance down in that area. So there's just lots of reasons why you'd want to go down to that area. And this instrument, pound dollar anyway, for me, it's so predictable. It's predictable in the sense of what it's going to do. What's not predictable is when it's going to do it.
Right. Yeah. Well, yeah. And the other thing that had happened was it had broken out of the previous month's high, and it had broken out of the previous week's high. And so to me, it was like, price doesn't like staying in the wick zone. But I think I was down at the M30 level, and it was like, it looked like it was going to come back the other way. And it basically had put in a red stripe here. And that happens when it makes a higher high, but then comes back down to the previous close and drops below. And it was like, yeah. And I said, you know what the pound likes to do, because it had dropped really quick. And it was like, it likes to run coast to coast. And so I said, you know what, this thing's going back down to 2,700. And I got one right.
Yeah, and that whole idea of coast to coast is kind of what I was talking about, what these instruments on the FOREX like to do anyway.
Yeah.
It loves to go to one extreme to the other.
Yeah, and you know what? We're almost at our extreme. The fastest 15 minutes in trading just about over. So, fellow traders, Always remember, never forget, it's not what you trade, it's how you trade it. So go out there and drain the banks. This is the Rumpled One, over and out.